You know, we go through our lives interacting with these massive trillion-dollar industries, and we almost never actually think about the plumbing that makes them work.
Oh, absolutely. It's totally invisible to us.
Right. Take insurance, for example. You buy a card, you need auto insurance, you buy a house, you have to get homeowners insurance, you pay your premiums every month, and, if something goes wrong, you file a claim.
Yeah, and to you, the consumer, it's just a portal on a website or like an app on your phone.
Exactly. But have you ever stopped to wonder about the invisible software engine that is actually running the multi-trillion-dollar property and casualty insurance industry?
I mean, it is entirely invisible from the outside, but when you look under the hood, you are looking at one of the most complex operational environments on the planet.
Oh, I bet.
The sheer volume of data being processed every second, the cross-border regulatory requirements, the mathematical modeling for catastrophic risk. It is just a staggering amount of computational heavy lifting.
And that is exactly our focus today. Welcome to today's deep dive. We have a fascinating piece of source material in front of us. We're looking at the Q3 fiscal 2026 earnings presentation from a company called Guidewire, and this is dated June 4th, 2026.
Yeah, it's a really dense report,
Yeah.
but incredibly revealing.
It really is. So the mission for today's deep dive is to unpack this dense financial report to understand how a massive, highly regulated legacy industry is quietly modernizing. We're going to look at the intersection of cloud technology and AI and how this one company is basically serving as the central nervous system for all of it. Okay, let's unpack this.
Well, to set the stage properly, I think it helps to understand that Guidewire is not just a software vendor selling, a helpful side tool or a productivity app.
Right, they aren't just selling chat software.
Exactly. They are the operational and financial backbone for the property and casualty industry, which we'll just refer to as the P&C industry from here on.
Huh.
We are talking about the core operating functions of the entire insurance lifecycle.
Let's break down what that actually means in practice, though, because core operating function sounds, well, a bit abstract.
Fair enough. Imagine a major hurricane hitting the coast of Florida.
Okay.
In the aftermath of that, an insurance company has to process tens of thousands of claims simultaneously. They have to parse different deductibles, factor in the age of thousands of different roofs, cross-reference local building codes for payouts, and, cut checks instantly so people can actually start rebuilding.
Wow, yeah, that is a massive logistical nightmare.
It is.
Yeah.
And Guidewire is the software that physically does that. It handles the pricing, the underwriting, the policy administration, the claims processing, and the billing. If Guidewire's systems go down, the insurance company essentially ceases to function.
That's wild. So whether you're evaluating enterprise tech or looking at investing trends or you're just insanely curious about how the modern world works, this company's Q3 results really offer a masterclass in dominating a highly specific niche.
They really do.
But to understand their financial success, we first have to look at the massive sandbox they play in. According to the data in our source presentation, the global P&C industry represents $3 trillion in direct written premium, or DWP.
Right. And just to clarify, direct written premium is just the industry term for the total amount of money customers pay in insurance premiums before the insurer pays out any administrative costs or passes risk onto reinsurers.
Got it.
So it's basically $3 trillion of raw revenue flowing through the system globally.
Which is just a staggering number. And what stands out about this industry is that it's both legally and practically compulsory. I mean, you literally cannot drive a car off a lot or secure a 30-year mortgage without it.
Sure.
That creates this incredibly durable sector that just steadily grows in lockstep with global GDP. Now, within that $3 trillion pie, Guidewire currently has $775 billion of DWP under contract.
That's huge.
Yeah. That spans across 349 core customers operating in 43 different countries. But the stat that really contextualizes their dominance, for me at least, is that 9 out of the top 10 global insurers use Guidewire.
Yeah, that level of market penetration at the absolute top tier of the industry is, well, it's pretty rare in enterprise software.
It is, and it brings up a major question for me. The tech sector moves incredibly fast, right? Yet we know that some insurance processes still feel totally archaic.
Oh, for sure.
Changing a massive insurance company's core software seems like replacing the engine on a commercial airplane while it is in mid-flight. So why is this industry so difficult to modernize? With a $3 trillion prize sitting there, why doesn't some nimble startup just build a slicker interface and disrupt them entirely?
What's fascinating here is that the barrier to entry is defined almost entirely by risk and trust.
How so?
Well, insurance is a trust-based industry that evolves very deliberately, mostly because it depends on precision and strict compliance at a massive scale. Think about it. If a social media app pushes a bad update and crashes, millions of people can't see photos for an hour.
Right. You refresh the page, maybe get annoyed, but life goes on.
Exactly. But if a core insurance platform calculates risk incorrectly or drops a database of policy limits, the financial and legal ramifications are literally catastrophic.
Yeah, so the whole startup mentality of move fast and break things is the literal opposite of what an insurer wants.
Precisely, and the presentation breaks down the structure of the market to really illustrate this. Insurers are categorized into tiers. Tier 1 insurers are the giants doing over $5 billion in DWP.
Okay.
And then Tier 2 insurers do between 1 and 5 billion. Those two tiers alone represent over 85% of all direct written premium.
Wow, 85%.
Yeah. This means 85% of the money is concentrated in massive companies operating across multiple jurisdictions with incredibly complex legacy IT systems. We are talking about mainframes built in the 1980s, running on ancient code, patched together through decades of corporate acquisitions.
It sounds like a total house of cards.
It can be. So a startup just does not have the track record to convince a Tier 1 CIO to hand over the keys to that operational kingdom. Guidewire has spent a quarter of a century building the trust required to handle these highly sensitive systems.
Because those legacy systems are so terrifyingly difficult to replace, because nobody wants to be the executive who grounds the airplane while swapping the engine, there has to be a massive forcing function to actually make these insurers switch.
Exactly. The pain of staying on the old system has to become significantly worse than the pain of upgrading.
Right. And looking at this presentation, that forcing function is undeniably the transition to the cloud, supercharged by AI.
Yeah, Guidewire points to multiple growth drivers in their presentation. They outline core expansion at existing customers, net new customers, a growing portfolio of new applications, and geographic expansion.
Okay.
But the through line accelerating all of this right now is AI. It is drastically increasing the urgency for modernization.
Wait, I have to push back on this a little bit. Every single tech company in 2026 is slapping the word AI onto their investor slide decks.
Oh, absolutely.
It's basically the mandatory buzzword to keep stock prices elevated. How much of this is Guidewire just playing the standard tech marketing game, and how much is actual tangible utility in the insurance space?
That is the critical distinction to make when evaluating these sources. In the context of core P&C insurance, AI is not a generative chatbot writing polite emails to customers.
That's it. Then what is it doing?
It is fundamentally about evaluating risk and digesting vast amounts of historical data to price policies more accurately.
Yeah.
Think about agricultural insurance, for example. Instead of a human underwriter spending 3 weeks looking at historical tornado data, local crop yields, and changing weather patterns to price a policy, an AI model cross-references 50 years of disparate data sets in seconds.
That's a huge time saver.
Massive. Insurers desperately need faster product velocity. Basically, the ability to design and launch a new insurance product quickly in response to market changes.
And I'm guessing you can't run those sophisticated AI models if your data is trapped in an on-premise mainframe in a basement somewhere.
You simply cannot. You have to be in the cloud to leverage that kind of computing power. So AI becomes the carrot that makes the massive headache of a cloud transition mandatory.
That makes total sense. And the Q3 results do show that insurers are actively buying into this. The presentation highlights specific adoption, like they secured 5 new wins for a product called ProNavigator.
Right. And to your point about utility, ProNavigator embeds AI-driven knowledge and workflow automation directly into their operations. It automatically serves up complex compliance rules for specific jurisdictions to underwriters so they don't have to hunt for them.
Oh, wow. So it's actively assisting the underwriter during the workflow.
Exactly.
They also had 3 wins for Pricing Center, and this looks like a global push. They mention a Swedish insurer, an insurer in Poland, and their first U.S. Pricing Center win, the Oklahoma Farm Bureau.
Yeah, and if you look at why the Oklahoma Farm Bureau selected the platform, the stated reasons align perfectly with that forcing function we were just talking about.
The cloud transition.
Right. They chose Guidewire to become more nimble in pricing and rating, to reduce their IT footprint, and to accelerate speed to market.
The presentation also features the Auto Club of Southern California. They signed a 7-year expansion on the Guidewire Cloud platform alongside a significant new sale of that Pro Navigator product.
That's a huge deal.
It really paints a picture where the cloud platform is the expensive foundation, and the AI tools are the high-margin capabilities they sell once that foundation is actually poured.
You can see the strategic impact of this in their massive net new wins, too, like Bradesco Seguro in Brazil.
Right, the Brazilian company.
Yeah. Bradesco selected the Guidewire Cloud platform specifically to consolidate a significant legacy IT footprint. Their whole focus was improving product velocity. AI and cloud agility are finally making that painful core system replacement worth the cost for these massive legacy carriers.
So we have established that Guidewire has a captive market and a very real catalyst in AI modernization. Let's look at how that actually translates into financials in this Q3 2026 report, because here's where it gets really interesting.
The numbers are pretty striking.
They are. The revenue composition tells a distinct story. Total annual recurring revenue, or ARR, hit $1.147 billion. That's up 19% year over year. And total revenue reached $373 million for the quarter. But the metric that really matters is their subscription and support revenue. That hit $245 million.
Which is huge.
Right. It didn't just grow, it shot up 35% year over year and is now eating up 2/3 of their entire revenue pie.
If we connect this to the bigger picture, that shift towards subscription and support revenue changes the economics of the company entirely.
How so?
Well, historically, enterprise software involves selling a massive license. The customer bought the software once, owned it, and maybe paid a minor maintenance fee. Moving to a cloud-based subscription model creates a highly predictable compounding revenue stream.
There is a chart in the presentation showing Guidewire's ARR growth from 2010 to 2026. For the first decade, it is a steady incremental staircase. But starting around 2021 and 2022, the curve turns into a hockey stick, pointing steeper and steeper upward.
Yeah, you can really see the inflection point.
How does a 25-year-old enterprise software company suddenly accelerate its growth curve like a newly funded startup?
It is a textbook example of the J-curve in a cloud transition. In the early years of moving a customer base from legacy on-premise software to the cloud, it severely hurts your margins.
It's like gutting a house while you're still paying the mortgage on it.
That is a perfect analogy. You are paying to keep the lights on in the old system while funding the really expensive construction of the new cloud infrastructure. You literally have to rewrite the platform architecture and run two distinct business models simultaneously while slowly migrating customers over.
That sounds incredibly expensive.
It is. It requires heavy upfront capital investment, which totally depresses profitability for several years.
But once the renovation is finished, the property value skyrockets and the maintenance costs plummet.
Exactly. And we can see vividly in this Q3 report that Guidewire has crossed that threshold. The heavy lifting of building the Guidewire Cloud platform is largely complete. Now that investment is paying off through massive margin expansion.
The numbers definitely back that up. Their non-GAAP subscription and support gross margin hit 74%.
That's a phenomenal number for enterprise software.
And just to translate the financial terminology for a second, non-GAAP, in this context, basically gives us a look at their core operational profitability by stripping out one-time accounting charges.
Right.
So a 74% gross margin on subscriptions, which is up 3 percentage points year over year, and their core operating margin hit 21%, which translates to $78 million. That operating income is up 69% year over year.
The operational leverage here is the key takeaway. When a software company hits 74% gross margins on its recurring revenue base, it means that every new dollar of subscription revenue they bring in drops almost entirely to the bottom line.
Because they've already paid for the expensive infrastructure.
Precisely. The cost to service an additional customer on an already built cloud platform is marginal. You're just spinning up server space, not writing entirely new baseline code.
Ah, okay.
That is why their operating income is growing at 69%, while their top-line revenue is growing at 27%. The operational leverage is fully kicking in.
Generating 74% margins on over $1 billion of recurring revenue creates a highly specific problem for a company. What do you do with a mountain of cash? How a management team answers that question tells us everything about their internal confidence, right?
Absolutely. Capital allocation is the ultimate truth serum for a management team.
Well, looking at their balance sheet, they're sitting on $1.15 billion in cash and investments. And they are aggressively returning a significant portion of that to their shareholders.
Yeah, the buyback numbers are aggressive.
Very. They have executed $398 million in year-to-date share repurchases, and $250 million of that was executed in Q3 alone. Plus, they still have $241 million remaining on their authorization to execute by the end of the fiscal year.
Buying back that much stock, especially when the company is performing this well financially, is a massive signal to the market. It means management is looking at their internal projections and deciding that their own stock is the best possible investment they can make with their capital.
Yeah, that is a huge vote of confidence. Now, amidst all that cash generation and those aggressive buybacks, there was one detail in the presentation that really stood out to me.
Oh, what was that?
They explicitly note that they maintain a strict $400 million minimum cash reserve. And the reason they provide isn't just for general corporate safety or like to fund future acquisitions.
Right.
They state it is explicitly to ensure customer confidence.
Oh, wow. Yeah, that's telling.
It proves that in the Tier 1 insurance software game, financial stability is literally part of your product features.
It goes right back to the barrier to entry we discussed regarding trust. If you are going to run the central financial and operational backbone for a Tier 1 global insurer handling billions in premiums, that CIO needs an absolute ironclad guarantee that you are not going to run out of money and fall.
Right. They can't afford for their core engine to just vanish.
Exactly. That $400 million reserve is essentially a billboard to the industry saying, we are structurally secure, your core systems will not disappear.
It's basically the cost of sitting at the adult table in global finance. And when you combine that rock-solid balance sheet with their forward outlook, the picture really comes into sharp focus.
Yeah, they raised their guidance across the board, didn't they?
They did. They raised their full-year fiscal 2026 outlook. Total revenue is now projected to land between $1.460 and $1.470 billion. And that core operating income projection was bumped up to between $314 and $324 million.
They are comfortable raising guidance because their future is highly visible to them, which is a byproduct of these enterprise cloud contracts. They noted their remaining performance obligations, or RPO, sits at $3.6 billion.
For those unfamiliar with the term, RPO is basically guaranteed money already locked in the vault for future years. It represents legally binding contracts that just haven't been billed or recognized as revenue yet.
It serves as a crystal ball for the CFO. It is $3.6 billion of contracted future revenue.
That's a lot of visibility.
It is. When you have a fully ramped annual recurring revenue base and an RPO, that large spanning multi-year contracts, the management team isn't guessing about the next few quarters. They have it mathematically modeled out.
So what does this all mean for you? If we synthesize this deep dive, Guidewire has effectively cornered the market on the invisible infrastructure of the $3 trillion property and casualty insurance industry.
Yep.
By suffering through the painful early years of the J-curve, gutting the house to transition to the cloud, and by embedding high-value AI capabilities directly into the core workflows of these massive insurers, they have unlocked a formidable business model.
They really have.
They have highly predictable recurring revenues, 74% margins, and incredible cash flow generation.
They've built a moat that is almost impossibly deep, protected by the extreme operational complexity and the heavy regulatory burden of the industry they serve.
This presentation really serves as a perfect case study in how value is actually captured in the modern economy. It reminds us that the biggest technological shifts aren't always flashy consumer products or viral apps.
No, they aren't. And this raises an important question to consider. Guidewire has proven that the most lucrative AI and cloud revolutions are happening deep inside the unglamorous, invisible plumbing of legacy industries.
That's a great point.
It really makes you wonder, what other boring, highly regulated sectors out there are quietly waiting for their own Guidewire to arrive and flip the switch to AI?
That is the perfect thought to leave you with. We started by talking about the invisible software running the background of your daily life, and it turns out upgrading that infrastructure is where the quiet revolutions are actually happening. Thank you for joining us on this deep dive. Keep looking beneath the surface of the companies that run our world.